In this video, we're going to talk about the important requirements when it comes to buying in a co-op building. This will help you understand what exactly co-ops are looking for so you can be prepared and avoid any delays and frustrations. What is up, everyone? My name is Sargis, a licensed real estate agent based here in New York City, and my goal is to provide you as much information as possible about New York City real estate when it comes to buying, selling, or renting. Let's start with three main financial requirements when it comes to buying in a co-op building. Number one is financing requirement. Every co-op has a maximum percentage that the buyers are allowed to finance in the building. The most common down payment minimum is usually 20 to 30%. There are a few co-ops that might allow 10% down payment, and I also have seen co-ops that require as high as 50 to 60% down payment. Some co-ops might not even allow financing. Assuming you know what price point apartment you're looking to buy and how much money you're planning to put down, knowing how much that specific building requires buyers to put down is one of the first things that you need to find out. The minimum down payment in a co-op is not negotiable, and if the building requires more money down than you're planning to put, you either have to come up with more money or just keep looking. The second requirement is what's called a post-closing liquidity, which means how much liquid assets you have after you complete the purchase. After paying your down payment and the closing costs, how many months worth of maintenance and mortgage payments you have available. Every building is different, but the general rule of thumb is most co-ops want to see at least 2 years post-closing liquidity. For example, if your mortgage payment is $4,000 a month and the monthly maintenance of the apartment is $2,000 a month, this is total $6,000 monthly housing payments, which means you'll need to have $144,000 in liquid assets after you complete the purchase. But for most co-ops, this doesn't mean that you will need to have a big savings account with money just sitting there. In general, the definition of liquid asset is an asset that can be easily converted to cash in a short period of time while maintaining its market value. There are a few factors that make the asset more or less liquid, such as how established is the market, how easily can the ownership be transferred, and how long it will take for the asset to be sold. The examples of liquid assets are cash, checking and savings accounts, money market funds. Investments such as stocks, bonds, mutual funds, US Treasury bills can also be considered as liquid assets. Retirement accounts such as 401ks and IRAs are less liquid because there are steep financial penalties for early withdrawal. The examples of non-liquid assets can be a land, real estate, car, jewelry, art collection, and things like that. Those are considered non-liquid assets because it can take a long time for someone to liquidate an art collection or a land. Now, when it comes to co-ops, every co-op is different. When you're trying to understand what your post-closing liquidity will be when you're buying in that specific building, things like cash, savings, and checking accounts are the most safe liquid assets to consider. The majority of co-ops will also be okay with including some investments I've mentioned before, such as stocks, bonds, mutual funds, to show as a post-closing liquidity. And when it comes to retirement accounts, some co-ops might let you use a small percentage of your retirement accounts in your post-closing reserves calculations, usually 20 to 30%. The example can be, let's say if you have $200,000 in your retirement accounts, they might allow you to include 30% of that money, which is $60,000 in your post-closing reserves. But again, it all depends on the building and how strict they are. Also, some buildings are flexible with how many months of post-closing liquidity you need to have. 2 years or more is considered safe, but if they're not too strict about this, you might be okay if you have a little bit less than 2 years. For some co-ops, 12 or 18 months might work as well. The third most important requirement is your DTI, which is your debt to income ratio. How much money you make per month in relation to your monthly debts, usually in percentage. For example, 25% DTI means that 25% of the individual's monthly gross income is used to pay off the monthly debt payments. So generally speaking, the lower the number, the better. The question is, how to calculate your DTI. Step number one is to figure out what is your monthly gross income. Let's say your annual gross salary is $336,000. This means that your monthly gross income is $28,000. Keep in mind that we're talking about the regular W-2 employees who are on a payroll. For business owners, contractors, freelancers can be a little bit tough, since in this case your qualifying income is not your gross revenue. It's a little bit complicated both for your lender and for the co-op, because they have to calculate your taxable income and certain deductions are allowed to be added back in. And they also consider other factors such as how consistent is your income, how long you've been in the business, and things like that. Self-employed people are also able to get mortgages and buy apartments. It's just requires a little bit more paperwork and the qualifications are different. For now, we're looking at W-2 employees. So step one is to figure out your monthly gross income. In this case is $28,000. Step two is to figure out your debts. In order to do this, we have to understand what counts as a debt. Any payment that an individual is required to pay back and is being collected over a long period of time and shows up in your credit report is a debt. The examples are your auto loans, personal loans, other existing mortgages. If you have credit card balances, the minimum payments of your credit cards also count towards your debt, plus your future housing payments, which includes your mortgage and the monthly maintenance of the apartment. Things like your food expenses, car insurance, utilities, phone bill, your gym membership, your Netflix subscription are not considered as a debt. Let's say the maintenance of the apartment you're trying to buy is $2,000 a month and your monthly mortgage payments will be $4,000 a month, plus you have a financed car with $700 a month payments. This means that your total debt is $6,700 a month. DTI formula would be total monthly debt payments divided by gross monthly income times 100%, which means your DTI in this example is 23.9%. This is one of the important factors that your lender will calculate in order to approve you for a mortgage. Ideally, you would want to keep this number as low as possible because banks view people with high DTI ratios as riskier borrowers. And on top of that, co-ops also do calculate your DTI ratio. And most of the time, co-ops requirements are much more strict than the banks. For example, if the co-op you're trying to buy in requires less than 28% DTI, it doesn't matter if you're qualified for a mortgage with 35% DTI. This means that you are still not qualified to buy in that specific building. Some co-ops might even give you in writing what your DTI must be, but the majority of them don't. And generally speaking, 25% and under is what's considered to be safe. But again, it all depends on the building and how strict they are. Those three financial requirements are the most important ones. There are of course more, but before we move forward, just know that the best thing you can do is number one, do research and educate yourself. Like now by watching this video till the end, also watching this video where I talk about the co-op ownership structure, pros and cons, and much more. And number two, work with a pro agent, someone who has done a lot of deals and knows how to properly guide you, answer your questions, negotiate on your behalf, put together your board package, and help you to go through your home buying journey with as less stress as possible. Since the majority of New York City residential housing market consists of co-ops, unless you're specifically excluding co-op buildings, chances are high that your desired apartment just happens to be in a co-op building. Despite the strict requirements and long complicated process, owning a co-op apartment can give you some really nice advantages and savings. Why co-ops are so strict and what are the advantages and savings when buying a co-op is a topic for another video. The bottom line is have a buyer's agent to watch out for your best interest, save you some time, and take away your stress. If you haven't clicked away from this video yet, just do me a favor and tap that like button and subscribe to the channel because planning, filming, and editing takes forever. Thank you for doing so. Now let's get back to the video. So minimum down payment, post-closing liquidity, and DTI are three major requirements that you need to satisfy in order to be approved in the building. Co-ops also have limitations when it comes to the source of your money and what you can do with your apartment. If you don't satisfy the financial requirements on your own, but you still wish to buy an apartment instead of renting, there are some ways to purchase a co-op with some help. The ways that someone can help you are either in a form of co-purchasing, gifting, or being a guarantor. Before we take a look at those, One important note here. Co-ops don't just automatically agree for someone to help you with the purchase. Every building has different rules when it comes to co-purchasing, guarantors, and gifting. Any or all of those can be either allowed or not allowed. So if you're planning to use the help of someone, either your parents, family member, or a relative, don't just assume that you can do so in every co-op. You need to search for apartments in the buildings where co-purchasers, guarantors, and/or gifting is allowed, depending on your specific situation. This is where your agent's knowledge and experience will save you a lot of times in making sure that you're following the right step-by-step process and you're not looking in the buildings where you don't satisfy the requirements. Now let's start with co-purchase, which can be allowed or not allowed. This means that two or more people are jointly buying the apartment. If someone is a co-purchaser together with you, both of your names will be on the stock certificate and the proprietary lease. If you don't know what are those and how the co-op ownership structure works, it's in this video. And if you're financing the apartment, your co-purchaser will also be a co-borrower on the loan. Both of you will be responsible for co-op's monthly maintenance, any assessments, and your mortgage payments. Both of you will have to fill out a co-op purchase application, submit all the necessary paperwork, and go through a co-op approval process together, including the interview. If you don't want to go with this route and have a co-purchaser, but you still need the help of someone, the next option is gifting. Gift also can be allowed or not allowed. If the co-op allows gifting, this means that all or any part of your down payment and closing costs can be a gift from someone else. The difference now is that you are the sole owner of the apartment and only your name will be on the stock and lease. In this case, most of the time, co-ops would want to see a letter from the donor stating that the money is indeed a gift and there is no repayment expected in the future, whether in a form of cash or any type of service, and no lien will be filed against the property by the donor in the future. However, your finances together with the gifted money still has to satisfy the co-op's requirements in terms of having the necessary down payment, post-closing liquidity, and an acceptable DTI ratio. And even if the whole purchase price is a gift and you won't have a mortgage, you still have to show enough post-closing liquidity for your monthly maintenance of the apartment, and your DTI has to be within the co-op's requirements. On the other hand, if gifts are not allowed, this means that the money you used for down payment and closing costs has to be your own money. Since they typically would want to see 2 or 3 most recent bank statements, any unusual large deposits that is shown in your bank statements will be flagged, and you have to have a clear explanation of the source of that money. Next, if none of those options work for you, the other option would be to use a guarantor. But guarantors also can be allowed or not allowed depending on the building. Guarantor is different from a co-purchaser. In this case, you're buying the apartment on your own, but you have someone to guarantee your monthly maintenance payments. Their name is not going to be on the stock and lease, but they basically guarantee the co-op that if you don't make your monthly maintenance payments on time, they will make those payments for you. Every co-op is different when it comes to what kind of paperwork is required from your guarantor. Some co-ops would want your guarantor to fill out the entire application together with you and provide all the necessary documentation that is required from you as a buyer. And other co-ops might just have a couple of forms for your guarantor, and depending on the building, your guarantor might or might not be required to attend the interview together with you. If guarantors are not allowed, this means that your own finances must satisfy the building's requirements. Also, you might see another requirement called parents buying allowed or not allowed. But if you remember, gifting is a situation where you're getting all or some part of your down payment and closing costs or the entire purchase price as a gift, but you are the purchaser of the apartment. While parents buying usually means that your parents are buying the apartment for you to just live there. In this case, you're just a resident, and co-op might or might not require you to be on the stock and lease. This is a common situation, let's say if an individual is a student or started an entry-level job in New York City and is planning to live here for a few years. Parents might decide to buy a place for him or her to stay instead of renting. In this case, since the individual's finances and credit is not enough to be qualified to buy in a co-op or take out any loan, this will fall under the category of parents buying instead of a co-purchase or gifting. In this situation, of course, you have to search in the buildings where parents buying is allowed. And the last one is not a financial requirement, but is still considered a requirement that you need to satisfy in order to be approved in the building. This is what's called a pied-a-terre, which again can be allowed or not allowed. Pied-a-terre is just a fancy way of saying that the apartment is being used for an occasional stay. This is a French word that translates as foot on the ground. If you say I'm looking to buy a pied-a-terre apartment, means that the apartment will not be your primary residence. Some people who visit New York City a few times a year on a regular basis prefer to buy an apartment instead of staying in a hotel. If this is the case, make sure that you're looking in the buildings where pied-a-terre is allowed. If it's not allowed, you have to claim that apartment as your primary residence. Otherwise, your application will not be approved if you're trying to buy an apartment for an occasional stay in the building where pied-a-terre is not allowed. And for the first-time home buyers or for people who are coming out of state, the thought of going through a co-op buying process might be overwhelming. You might be thinking,
I'm qualified and have enough money to buy. Why do I have to go through this long and thorough approval process and hope that I won't get rejected?
And you're right, but that's why the professionals exist. Since every co-op is different when it comes to financial requirements, your agent should be able to provide you all the necessary information about that specific building and make sure that your financial profile does satisfy the building's requirements in order for you not to waste your time. Before we finish the video, I wanted to mention that I'm doing weekly 30-minute one-on-one consultations completely for free. If you're looking to buy, sell, or rent in New York City, or if you just have questions regarding New York City real estate. You can see my email in the description of this video. You can just shoot me an email to book your one-on-one session. That's it for today. Hopefully you got some value out of this video. And if you want to see a detailed breakdown of how much money you need to buy a home in New York City, you can just click the video you see on your screen. Thanks for watching. Until next time.